Factor investing is simply rules-based investing. Now, if you go back about 20-30 years ago, when you had a fund manager who generated outperformance, you said, great job, we're going to give you more capital, and you continue to generate outperformance. What better data and new technology has shown is that most of the time outperformance can be explained by certain factors. And these are simply rules-based systematic strategies. So if you have a fund manager that generated outperformance over a consistent time, and you realize he's doing nothing more than basically giving you exposure to a certain factor, you can replicate that and you can make it more cheaply, which is why factor investing has become so important. It effectively allows you to explain stock returns, often in the context of evaluating a fund manager, and allows you to effectively replicate what that fund manager is doing. So I think most investors will be familiar with the value strategy. Now, value strategy in its simplest terms mean you buy cheap stocks. Now, from a factor perspective, it would be indeed you buy the cheap stocks, but you short expensive stocks. And that's how you basically create the value factor. Now, that's from an academic perspective. In practice, most products are more on the long-only side, so you buy the cheap stocks, but effectively you're trying to capture this rules-based system. The other factors that are quite well known, aside from value, are momentum, which is buying winners, shorting losers, is the size factor, which is buying small caps, and quality and low volatility. It is worth mentioning there are many more factors. The other two factors that are worth highlighting is dividend yield and growth. Having said that, dividend yield is usually more considered a sub-factor of value because you can rank cheap stocks also for the dividend yield. And the growth factor, although there's a lot of capital allocated to it, is actually not something that is established from an academic perspective, that it does generate positive exit returns. Simple reason is that growth stocks usually tend to be expensive, so it is to a degree the opposite of the value factor.